The following presentation by Monument Capital Management LLC is intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Monument or any other investment professional of your choosing. Please see additional information disclosure at the end of this presentation. A copy of Monument's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.monumentwealthmanagement.com.
One of my favorite investing quotes is, "Sometimes you make more money sitting on your hands than tap dancing on your feet." Welcome back to another episode of Off the Wall. We all know markets continue to move fast, so we're here trying to help you keep one step ahead. I'm Nate Tonsager, and as always, I'm joined by Monument's founder and CEO, Dave Armstrong.
Hello, everybody. Yes, good to be back.
Yeah, we missed you last episode. It doesn't feel the same when you're not around.
Yeah. Well, we're here for another one of our Ask Monument Anythings or AMA episodes. And we like this. This is where we're answering the smart questions that, our clients and investors are asking us now. So every day we're having conversations and people are asking us different questions and we jot them down. And some people even email in questions into the mailbox that we have set up for this, which we'll give you again at the end of the episode. But we thought it was kind of cool to answer the questions that people are asking us every day. So here we are.
Yeah. And again, because we know things move fast, just so everyone understands, we're recording this on November 19th, a lot going on. But today we're diving into three topics that we've gotten about what's going on in the markets. And today specifically, we're going to cover, the status of the U.S. labor market, the valuations in technology stocks specifically, and I think kind of a fun one for me personally, maybe a little bit philosophical, but Warren Buffett's investment legacy. So, Dave, I'll start the drum roll.
Yeah.
Where would you like to start between those three topics?
I want to start with the tech stock valuations because I think that of the other two topics, this topic is really what's driving some of the recent weekly volatility that we've been seeing and daily volatility that we've been seeing in the market. So I'd like to start there because I think that's probably the most immediate question to answer for everybody.
Yeah, I couldn't agree more. That's kind of what I thought you would pick, honestly. So, the specific question we got, but we can go any way with it, is, recently major investors that you hear about on CNBC in the financial media are raising concerns that tech stocks are wildly or even just overvalued. Mm-hmm. And I think the main question is, are they right to be worried about these valuations? And what is kind of the meaning of that?
Yeah, well, I will try to be as succinct as possible here. But, again, important for listeners to remember here is, first of all, saying again, we're recording this on Wednesday afternoon, the 19th of November. And that's important because NVIDIA is going to report tonight after the close. So as soon as we wrap up with recording this podcast, we're going to get news that's going to drive the market one way or the other. And hopefully there's some good news with NVIDIA. But nonetheless, there is just a very high level of concentration in the S&P 500. And it presents an interesting mix of advantages and disadvantages to investors. And a lot of this is driven by valuation. So on one hand, outperforming the index right now is difficult because, it's difficult. And the traditional asset allocation foundations, things like diversification, they're causing good portfolios to lag a little bit. Now, on the other hand, the market has been doing so well, and most clients are likely in large cap equities for a significant portion of their portfolios, which has left them pretty happy about their portfolio performance this year. So even as some of these companies are trading at these lofty valuations, there just simply hasn't been much evidence that the trend is going to reverse anytime soon. So now, on to actually addressing the question, Nate, which is, the weighting of the top 10 companies in the S&P 500 has more than doubled from 20% since the end of 2016 to now right at around 40%. That's a big move. So as fans of our podcast already know, the S&P 500 is a market cap weighted index. So the stocks with the largest market cap carry the most weight in performance. And so this is really important to understand as we talk about index performance and valuation. So other than 2022, The weight of the top 10 stocks in the S&P 500 has increased every single year since 2016. So for some context here, the largest stock in the S&P 500 in 2016 was Apple, and it had a 3.19% weight. So 3.2% weighting, okay? Today, NVIDIA, which is the largest stock in the S&P 500, makes up 7.99, so 8%. So 3.2 to 8%. That's a 2.5 plus times increase in weighting. So no matter how anyone looks at this, the market is real. The market, when I say the market, I mean the S&P 500 market, is heavily dependent on just a few companies, for better or worse. I'm just saying that's the case. Okay, so what does it mean to listeners? What does it mean to clients? What does it mean to investors? Well, while growing account values it's great, and it's a big part of what we do. Our clients' primary goals include a lot of other things, though. Like it includes things like feeling secure in retirement and passing along resources to their children and grandchildren and supporting charitable causes, things like that. And the bottom line is that while maximizing returns is tantalizing, right? Particularly in such a strong market like we've been in over the past 3 years, risk management is as important, and maybe more so now, than maximizing your growth. So risk management is what protects investors and protects our clients' optionality. So that's my little rant on valuations right now. I think that it's just important for clients to understand what's happening and what's causing it, and why a well-diversified portfolio may be underperforming the S&P 500 right now.
Yeah, I think you can't really talk about valuations with also talking about the concentration that we're experiencing at the index level.
Right.
Why is the market going through volatility just because one sector of the U.S. economy appears to be overvalued? I say they go hand in hand. And, to your point, those 10 companies, or the top 10 companies in the S&P 500, make up 40% of the index. So when NVIDIA reports earnings later, the math is saying they're expecting about an 8% move in NVIDIA, either up or down, whether the market likes the earnings. And that's going to dictate what the index does, at least in the short term. And I think, looking at the top three, you mentioned it with Apple, NVIDIA, Microsoft. These are some pretty expensive stocks when you look at them in traditional metrics. But I think expensive doesn't mean you're not worth it. You can pay a premium price for a product if you want to buy, and these aren't endorsements of these products, they're just the ones I use personally. You can buy Yeti products, Yeti coolers, Yeti mugs, but you're going to pay a lot to do it. But I enjoy what they provide, those premium services that they offer. So if you're paying for something that's worth it, it might make sense. And I think to use a little bit of the data that we rely so much on is looking at what we call PE ratios, or price to earning ratios. And Dave, I think you've talked about it before, but what you're looking at there is every stock, you can calculate its PE ratio, that price to earnings. And what that's trying to show is for $1 of that stock's earnings, and remember, stocks are driven by earnings growth over time. So every $1 of earnings, what is the price you're paying? Kind of level sets the market. And on average, the S&P 500 is usually around 20, is what they say is a fairly valued market. Well, the NASDAQ, more tech-heavy focused, because they are those longer-term growth, usually are a bit more expensive. PE of that index, the NASDAQ, which again are those tech-based companies usually, is around 25. Well, guess what? If you look at the Mag 7, those 7 top tech stocks, removing Tesla, you're about at a 30 PE. So on that metric alone, you are a bit more expensive than what history says. But I think what always gets lost in the shuffle is if you look at those Magnificent 7 names, they're responsible for 26% of the S&P 500's total net income. So looking at all the companies out there, the Magnificent 7 stocks make up a quarter of the income growth that we've seen over the past 12 months. That's a pretty concentrated market, but that's why they're getting those higher multiples. So while they can appear overvalued, again, if you have a reason to justify it, which this is just one metric, there's a lot of metrics out there. I'm not saying PE or earnings growth is necessarily the be all end all, because I think we can get into a little bit of what does it mean to be overvalued, but you're paying a premium price for stocks that are growing, which isn't necessarily a bad thing, even if there's volatility.
I'll tell you that all makes complete sense. I personally, in closing up this topic on valuations, I just want to stress to investors, and here comes the Dave Armstrong broken record, right? I get it. But I just want to stress that investors need to understand the set of cards that they're holding in their hands right now. So, and I'm not saying it's good, it's bad. I'm not saying if you're 100% in NVIDIA and that's your ride or die, whatever. I don't care so much as I care about everyone listening to this episode right now making very clear, conscious choices about risk right now, because more is not a good investment strategy, because you can't. Well, what is more? So I don't have an axe to grind in this whole debate over NVIDIA and market concentration. What I really want to stress is that you've got to understand what your portfolio is holding right now, why it's performing the way it is, and are you okay with the risk that you have in it? Because it just crossed over my 26-year anniversary in this industry, and I'm telling you, the thing that I have seen destroy people's portfolios more than anything else is not moderate underperformance relative to the S&P 500. It's making catastrophic errors in overconcentration and losing money. That's been the most catastrophic component to anybody's failure of success in their investment strategy. So just please, everybody listening, just know what you got.
Yeah, and I think it gets to, you talked about all these things about knowing what you own, but know when you're going to sell it. And I think at Monument, what we really look at is trend changes. And Dave, I think you kicked off this segment by saying the trend in tech stocks remains strong. So right now, it might be okay to hold NVIDIA, whether the earnings are bad or they're good or there's continued volatility, but you always have to be aware of when are you going to decide to either take some off the table, sell out of it completely. And it doesn't necessarily always have to be little shifts in the market. You got to figure out a way to identify those significant trend shifts, which is a key focus of what we do here at Monument when we're managing portfolios. So valuation has never been a great predictor of short-term performance.
Right, exactly.
So if something's overvalued, it can go up or down from there. Longer term, there's more data that say, you want to buy fairly valued stocks. But when you're trying to ride trends, you can have a overvalued stock that if people want to buy it, the price is going to keep going higher. And don't be afraid to ride the wave as long as you're working to identify when that wave shifts to get out of the way of that crashing kind of sea of selling that can happen.
Yeah, right. So, okay, so that kind of puts a bow on that topic. Which topic of the remaining two do you want to jump on next?
I think I'm seeing at Monument as the economic data guy. So let's go labor market. I think that's the one that is more interesting to me.
All right, fair enough. Here we go. So the question that we actually got was, how would you grade the current state of the U.S. labor market? Now, that's a tough one because how do you grade it? But we're going to try. So thanks for that question. Appreciate it. Nate, why don't you just try to tackle that and give your initial response? I'm kind of interested in what you have to say on this.
So given that it's end of the semester, right? We're coming up at the end of the year. We'll just go traditional A through F. I'm going to give it a C. Now, first off, I need to qualify this C. Is a saying that I always heard growing up, and this is more about, I think, the friends and the environment around me, is C's get degrees. You can graduate with a C, but you're barely graduating. So I think level setting it there is what's important, because when you look at the labor market, it's not collapsing, but I definitely wouldn't call it strong. And I think the sentiment we're hearing right now is a no fire, no hire kind of labor market. And I think what's made it really difficult to grade the labor market is during the shutdown, there was not a lot of government data that was coming out around the labor market. People rely on the unemployment reports, on the job creation numbers. They weren't coming out. And again, we're recording this on the 19th. Tomorrow on the 20th, we're actually going to get some of that backward-looking data, but it's going to be a little bit stale. So it might not be as impactful. So what that's led us to do at Monument and across the investing space is look at alternative data sources. So there's a private data series that comes from the Challenger analysis group, and they do a jobs cut report. And what they look at is state labor departments and who is announcing layoffs and announcing them to the state labor department. So not federal data, state level data. And in the past month, in October, there was 153,000 job cuts announced, which is up 175% when you look at it from the cuts a year ago.
Right.
So we are seeing more announcements of cuts. Now, I think the the key here is why are we cutting jobs, or why are people announcing these cuts? It's really because of, I think, a handful of reasons. It's cost-cutting pressures to preserve their margins. So companies, need to continue to make money, and how you cut costs, you can reduce labor costs, but only if you are kind of benefiting from productivity in other spaces. So I think adoption of AI is causing job cuts, while at the same time, you're also seeing a little bit of people overhired in the pandemic era. So there's a little bit of natural just kind of reversion to the mean aspect. And I think finally, while that number sounds scary, 153,000 job cuts announced, that's not mean everyone gets fired that day.
Yeah.
What that means is these companies are saying, we have plans to do this. So it's really only kind of a speculative report. I think what we get in the government jobs data, which show actual layoffs and unemployment insurance, are really going to dictate where we go from here. So that's kind of why I'm giving it a C, is you are seeing an environment where job cuts are starting to be announced. But what you're really seeing also too is companies are really trying to make sure that they're still being profitable for the long term. So it's a weird, while people call it the no hire, no fire environment, I think we're leading more towards fire, but not hire. And that's a little bit because of productivity from new technologies that we are seeing. Again, getting back to the tech valuations. Sure, people are spending on AI, but there's adoption and productivity that I think is coming from it.
Yes, I'm really trying to find a way to have sort of interesting rebuttal or devil's advocate position on that, Nate. But I'm in total agreement with you. I mean, it's tough. It's tough to take a counter to that, because I'm in total agreement with you. Look, I just think it's really hard right now for college graduates to find a good job. A lot of those entry level positions that just hire young college graduates to come in and do, data entry, administrative work, things like that. I mean, AI is really doing a lot of that stuff now. And I think people are saying, like, what do I need to hire? I mean, I'm not a lawyer, but I can pretend to be one for a second and say, are we going to hire somebody coming out of law school that's going to do all this research for me when I have AI available to me to do the research for me? And I just think that's really driving a lot of these decisions. And or companies are looking at it and saying, hey, before we hire a whole bunch of, let's just see how this whole thing shakes out. But it's the fire, no hire scenario. I mean, I don't think that's, we're a small company at Monument, right? We got 10%. So that's not, but like with big companies that have a lot of people and they can afford to trim some fat and increase profit margins, I see that happening. So yeah, I'm with you.
I think the best anecdote that I've heard about this is the Shopify CEO. And I think we talked about this earlier in the year, but the policy is stuck of, at Shopify, if you want to hire someone new, you have to make the argument and prove that job cannot be done by an AI tool.
Mm-hmm. Right.
So now imagine that. The barrier of entry is not just, are you qualified? It's, does the job role that you were going to be applying for actually be necessary? And there's good and there's bad from that. Again, I mean, we are seeing, I think, strong investment returns, strong earnings growth, because companies aren't being wasteful with labor. But there is something to about, the days of the job hopping, going from one job to another, especially in the pandemic era, and seeing large pay increases, which are actually a significant contributor to inflation. Let's not forget that. The more money people make, that M2 supply, or the money supply, drives inflation higher.
Mm-hmm.
But that's a thing of the past. And I think that's actually a very healthy thing for the economy. I don't think workers really like it, especially because there's also data now out that says 55% of Americans are concerned about losing their jobs. And that's according to Bloomberg News poll. But half of the country is concerned about losing their jobs. So what does that do? Causes people to manage their spending and hopefully get prepared, to break out the Monument broken record a little bit. Again, this is the moments you prepared for, are the unplanned financial changes.
Yeah.
So, if you're ever thinking about, do I need to have cash on hand, savings, we always say 12 to 18 months. If the economy is tightening on the labor market, that doesn't mean you are going to lose your job, but that doesn't mean you shouldn't be prepared for unexpected things.
Right. And this isn't entirely important to the topic of conversation of investing or anything, but I'll just throw this in there because it just kind of came in mind. But look, I think the days of the employees having the employees having leverage over the employers that we saw 5 years ago, and COVID and things like that. I think that leverage of wanting to work from home every day is a little bit over as well. I think corporate America has found a balance somewhere, and it's common to see, hey, like work from home on Mondays and Fridays, and you kind of have that longer weekend, but people are still working on it. But this whole thing of working Monday through Friday, just not coming to, I just think that people who are looking for those kind of jobs in what we were just talking about in a tighter job market where people really aren't hiring, like the people have lost their leverage. And if people want a job, they may have to take jobs where they go back to the office 5 days a week. A lot of big Wall Street firms are bringing their people back 5 days a week and saying, look, if you don't want to come back to the office 5 days a week, go find another job. But okay, 5 years ago, you could hit that bid if you were an employee, but these days, boy, it's kind of tough. So I think there's been a little bit of balancing out in the leverage.
Yeah. And Monument has remote staff. And I think the key thing that I've always learned from being that is you have to work harder to stay connected with your team.
Yeah.
And at large corporations, that just is very difficult.
Mm-hmm.
When you have a small, close team that communicates as strongly as some other places, or as we do here at Monument, to brag a little bit, that allows remote culture to work. But you have to put in more effort almost in being a remote employee. What you're getting in the benefits of not having a commute, basically, is the big one that people say. You're putting in extra effort to make sure you're staying on top of the business overall.
Yeah.
And I think, again, it speaks to productivity.
Yeah. And I know you're grateful that you don't have to come sit with me every single day, but yeah.
Well, I enjoyed the chats across the desk because it does add value. And to kind of pivot it back towards investing and all in the economy is, the economy is based on productivity and people. And right now, I think we're trying to blend, how do we get the people to mix with the productivity that we're seeing in AI. So It always comes back to AI, doesn't it, man? I another broken record statement. So.
Yeah. And for people who don't know or are listening and don't, our work environment here in the office in our global headquarters here in Alexandria, Virginia, it is an open work environment. So we work on more of like what you would think of as a traditional trading desk, where there's nobody has an office here, and people and that sort of environment is a lot of fun because you get a lot of energy off of people. You hear phone calls, you're learning from people, you're involved in conversations across the desk and stuff like that. So that's what you meant by it's fun to come to work and have chats across the desk, because that's literally, we have chats across the desk. So actually, you can get on the website and see some of the pictures of our office, but it's a pretty fun work environment. And then, of course, the dogs are running around. But anyway, that's not what we're here talking about. We've got one last question. Nate, I'm going to kick it over to you, which is that, what's the best piece of advice? If I slaughter this question, but I think it was something, basically, it was like, what's the best piece of investing knowledge you could take away from Warren Buffett's career, or something like that, right? Did I get that right?
Yeah. And I think we got a little philosophical there with remote work environments.
That's all right.
We're
having fun.
And now we're about to get real philosophical, because I think Warren Buffett, everyone is familiar with, is one of the most famous investors out there.
Yeah.
He is stepping down at the end of the year from Berkshire Hathaway. And he wrote his final letter, which every year it seemed like it was, Black Friday sales, Christmas drops. And then right before that was always Warren Buffett's annual letter on state of the markets. And he's added a lot of value to Berkshire Hathaway over his career without being very flashy. So what I actually took away, and there's a lot of great quotes that he's given throughout his, 67, how many ever years that he's been in there, he's an investing stalwart, is from his last letter that he wrote most recently. And I'll just read the quote here, but our stock price, so Berkshire Hathaway, will move capriciously, occasionally falling 50% or more, as has happened 3 times in 60 years under the current management, his management. But he says, don't despair. America will come back, and so will Berkshire shares. And really what that means is, to me, if you have a long-term strategy, and that was what he was famous for, was having a long-term focus on investing, you can be successful, but you're going to have to take those big drawdowns from time to time. And I think it's interesting that we're recording this during a smaller drawdown that is still under 5%, but stock markets follow that same rule.
Yeah.
The stock market is one of the greatest places to create long-term wealth, but you got to have a long-term focus and be able to withstand volatility. And we say this quite frequently, that, a 5% decline in the S&P 500 happens about twice a year. 10% happens about every 18 months, and a 15% decline happens every 3 years. Well, when you look at 2025, I think a lot of people think it's been a volatile year given what happened earlier in the spring, but it's really been a quote unquote normal year. April's sell-off hit that 18% decline, so past 15%, but it's been about 2.5 years, so a little bit under 3, since we had that last one in August of 2022. And since we've had that decline, granted, we're coming up around a 5% decline now. We haven't had any other declines of 5% or more. So this year we've had one decline. It was a big one, but we've come back from that, and it was almost right on schedule, which I kind of hate to say. The markets are unpredictable. I'm not going to, I can't tell you when it's going to fall off, but if you stayed invested throughout the entire year, the S&P 500 is up around 13-14% year to date. And since the market bottom in early April, when we had that volatility, it's up over 30%, closer to about 34%. So what I took away from Warren Buffett is having that long-term strategy and sticking to it to absorb those drawdowns. It's natural, it's normal, and it's how you're going to be successful over a 60-year career like he's had.
Yeah. My folks were down visiting this weekend, and my dad at some point over the weekend said, so what's happening in the market? I was like, what always happens in the market? We have these 5% pullbacks, we have these 10% pullbacks. I'm like, is there a reason? Hell, I don't even know if there's a reason. It's just sometimes it just happens, and then people attach a reason to it. But I would just say this to clients, and then I'm going to give my Buffett thing. But I would just say this to clients and investors, anybody listening, is that if all of a sudden you're looking at it and you say man, the market's really been selling off and it's between a 4 and a 5% pullback right now, you should be asking yourself a question of what happens if this goes down 10, or what happens if it goes down 15, or what happens if it goes down 20? Because, over the course of my career, I've seen it down 50 in the S&P 500 in, 2008. So if you feel like your ability to do what you want to do with your money is being impacted by a 5% pullback in the market, you should be asking yourself some really hard questions about what would happen, because as Nate just said, statistically there are probabilities of it going down 10, 15, 20%, and it just happens. So these are great opportunities for people to just do a little fire drill with their own emotions and ask themselves, hey, if a 5% pullback is kind of hurting me emotionally right now, maybe that's a sign that I've got too much risk right now, or maybe I should be thinking about this or talking to my advisor or something like that, because these are great opportunities to do a fire drill, I'll call it. But it's hard to have a really edgy rebuttal or anything to say related to Buffett. What I love, here's what I love about Buffett the most, is that his best advice is behavioral, not quantitative, right? His best advice isn't about you should be doing this or doing that, or take a look at this PE ratio or the moving day averages or something, whatever. It's always about managing your behavior, which I think is most applicable to our clients and listeners. And Buffett shows that disciplined patience beats consistent trading. And I recently had a conversation with somebody who called themselves a day trader. And I was like, well, geez, I don't know, because I have yet to meet a successful long-term day trader. So, but here's the thing about Buffett, right? Is that you build wealth by owning great companies and holding them long enough for their value to compound. That's just sort of his thing about building real wealth. And so focusing on quality, staying invested through volatility, and letting time do the heavy lifting for your portfolio, which folds neatly back into what we always say, which is, hey, you stay invested through volatility by having enough cash available to live out of when markets are selling off, so that you're not selling your securities when there's a pullback in time. So I will close my portion of this thing with Buffett by just one of his quote from his 2022 letter, which was something along the lines of the world is full of foolish gamblers and they'll never do as well as a patient investor will. So I that quote has always stuck with me, but that's my favorite Buffett quote right there.
Well, and I don't know if it's a Buffett quote, but one of my favorite investing quotes is, sometimes you make more money sitting on your hands than tap dancing on your feet. It kind of holds to the same mantra that a lot of, I think, has made people successful investors is really it's having a plan, it's sticking to it. But I think more importantly, and this gets to maybe a secondary quote from his letter that really stood out to me, is greatness doesn't come through accumulating great amounts of money, great amounts of publicity, or great amounts of power in government. When you help someone any of thousands of ways, you help the world. I think kindness is costless, but also priceless. And really, that's a cheesy one, I know. And maybe it's because I become a father this year that I'm now into cheesy quotes and lifestyles. But when you think about that, really what it is you can have all the wealth in the world. And he did. He had a lot of wealth. He was public. Again, he's Warren Buffett. Everyone knows him. But he wasn't out there on CNBC every week saying the market's going to decline, fear everything, or the market is going to be great, making predictions. I think he really understood, and even through his philanthropic efforts by giving a lot of his accumulated wealth away, savvy tax move, by the way, if you think about it, but not tax advisors, not tax advice. If you want that, we have another podcast, but it really shows that money alone isn't what gives life purpose. I think he knew it, and we all know it, that real financial success is about using that wealth to create alignment across every aspect of your life. So whether your goal is XYZ, ABC, having a plan that gets you there and keeps you invested over the long term really helps your money support your values, your choices, and really gives you a lifestyle that is a peace of mind. I think when you pair wealth with purpose, that's how you get as rich as Warren Buffett. And he always had that. So again, it's cheesy, but after spending 17 years in the investment industry, so not quite as long as you, Dave, but that sentiment is so often overlooked with people with the disease of more. They want more and more wealth, not about, is my wealth achieving my goals and is it giving me peace in my life?
Yeah. I mean, you said it. I'm going to say it again because I think it's worthy of repeating, but your wealth needs purpose. And I know from my time in the industry that our clients thrive when they have the optionality that the wealth affords them. So it's just another way of saying the same thing you said. But yeah, thanks for the insight, and thanks to our client for sending in that question. I think it was a good one. We always love talking about Buffett around here. So, look, everybody who's made it to the end of this episode, thank you so much for listening. Thank you, Nate, for another great conversation. I will throw out just a quick. I have a couple asks. One is if you want your question answered on our next AMA, you can submit it. You can do it a couple different ways. If you're a client, you know how to get in touch with us. But for other people, we have a special email box set up for this, which is offthewall@monumentwm.com. So that's all, no hyphens or anything, offthewall@monumentwm.com. But also something else I would just ask if you enjoy this podcast is if you could go just rate it on Apple or Spotify, just quick hop over and just give it a 5-star and write a little just like, hey, I thought it was great. That really helps us a lot. I'd personally really appreciate it. The other thing that would be really great too is if you like the podcast, hop on over to our Google reviews and just leave a comment there on our Google reviews. I mean, even if you're not a client, if you like the podcast, just say it on our reviews. That's really helpful in this day and age of AI and search and all of that. So I would really appreciate that.
And I know we got a little philosophical on today's episode. Off the wall, we really do try and focus on financial markets, investing topics. But I think it's also important to call out that financial planning is also a key piece. And we recently launched a second podcast at Monument called Between Sips that is really specifically focused on timely financial planning topics, estate planning, charitable giving, that really helps people think about the complexity around their options and life decisions. So you can subscribe to Off the Wall, Between Sips on YouTube, on your favorite podcast provider. And that'll allow you to get all the episodes for both shows as soon as they're released. So right at the top of your feed, you won't even have to look for them. I get notifications, and subscribing is the best way to do that. So whether it's investing, financial planning, check out both episodes so you can hopefully get some of that advice and some of the topics that people are thinking about.
Yeah, great. Thanks for that. And it sounds like Jax needs a little attention there in the background. So I'm glad he's cheering you on in the background there. So
Yeah, that's the thing with Monument is you're gonna get a dog-friendly environment, and
that's right.
Yeah, you can't avoid it. So
yeah, all right, we'll give him a scratch behind the ears for me. So okay, with that, we'll see everybody on the next episode of Off the Wall. So goodbye.
The previous presentation by Monument Capital Management LLC was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Monument or any other investment professional of your choosing. Different types of investments involve varying degrees of risk. It should not be assumed that the future performance of any specific investment or investment strategy or any non-investment related planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Monument's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Monument is engaged or continues to be engaged to provide investment advice services. Monument is neither a law firm nor an accounting firm. No portion of its services should be construed as legal or accounting advice. No portion of the video content will be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Monument is engaged or continues to be engaged to provide investment advisory services. A copy of Monument's current written disclosure brochure discussing our advisory services and fees is available upon request at www.monumentwealthmanagement.com.